Good morning, everybody. Welcome to the Flow Show. It's Monday, 19th of February, and here we go again, doing battle with the markets. Morning, Kay. How you doing, mate?
Good morning, Ryan. Yeah, we're doing well, mate. I mean, start of a new week. Quiet start, I guess, with the US and Canada closed. But it's nice and an easing into the week.
Yeah, exactly. That gives us a chance to get prepared for the week to come. Though it's not an overly busy week on the data front, I've noticed, but we'll go over the data points to come this week a little later. Right. Well, someone who's back in markets is China, and they've come back in pretty much as they've left before the holidays. The PBOC fixed the CNY reference rate at 7.1032. Their prior fix was 7.1036. So, as I say, start as they mean to go on. So they're keeping the FX fixes well down, despite we've seen a bit of a rally in one pairs. They left their MLF unchanged, but it's been touted in state press that they're likely to cut the LPR tonight. So that's a bit of data just to keep an eye on for tomorrow. Where we go? Where was it? Lost it. There we go. So these are the rates here. Expected to cut somewhere between 10, 15, 20 pips off those rates. 10 pips they're expected, but it could be anywhere between 10 and 15 pips off of that rate. They have got the difference between the 1 year and the 5 year rates there. So some in the market expecting one of those to stay unchanged and the other one to come down, but we shall wait and see. It's expected that they cut them. Whether they cut one, both, or how many remains to be seen, but it's just still part of the easing process that they're going to start going through or continue to go through. Stock markets in China haven't opened particularly well today, and it's going to the shorter term just to give a quick flick at those. I'll get it on the screen, depending on which one you want to look at. Had a bit of an off day, as you can see there, as they came back into the market. Small up on one of them, the China 300, but the 8, they've got different ones here, the 500 as well, not looking overly good, closing down, as you can see there on the day. So not a good start. It remains to be seen what happens in the early part of their return to markets. Do we see a big unwind of all the positivity put in place before the holidays by them interfering in markets again, or are we going to get back on the slide? Certainly there's no real appetite still from foreign investors to get involved, which is one of the problems here with China. Coming over to some data, a bit of data out of Japan. Back there, core machinery orders. Coming in as expected, a positive month, turning around the loss seen last month. Year on year, bit of an improvement, not as bad as expected on that. So that closing off the year for that part of the economy there. So that will likely be reflected in the GDP numbers, which were a bit soft. Whether it does anything to meaningfully improve those remains to be seen. Over in at the Bank of England, and BOE's Peel said that the economic situation in the UK looks a little less benign than in the US. It says weak activity in the UK is not putting much downward pressure on inflation. He wants to see a further easing of wage pressures, and says based on the data, getting to a point of reducing the bank rate is still some way off. We'll have to wait several more months before he could be convinced that persistent inflation has gone. So a little hawkish slant or undovish slant to Bill's comments there from the BOE. I think he's spot on. It's going to be a while before we really get around to looking at cuts from the UK unless the data starts falling off a cliff. What has fallen off a cliff is French GDP forecasts for 2024. They've been cut to 1% from 1.4% previously. Finance Minister said that spending cuts will be made across every government department with immediate effect. So bringing down the hammer on that. Anything you caught out of Asia or Japan this morning, mate?
No, not really. Again, a lot of opinion pieces, but not really seen anyone officials apart from the Chinese premier urging a forceful action to boost confidence, to boost the economy. Is that a hint at or a wink to the PBOC to cut their rates tomorrow? That's a possibility. But for the rest, it's been very, very quiet on the officials front.
Yeah, very much so, mate. Not much to come from them. Yeah, as I said, we'll have to see how much China's going to influence things in these early parts. I noted pick up in gold this morning. I don't know if that's geopolitical or maybe China coming back and getting the Hoover out once again.
Probably a bit of both.
Yeah, it looks a bit of a clear picture, perhaps, that gold came off while they were closed, and now it's picked up again. Now they're reopened. Looks a bit suspicious, that move. We know China have been a big buyers of gold. They may have just switched off for the holidays. Right, coming over to some of the other data and look at the data from Friday, mainly in the US. A bit of a mixed data. Obviously, the PPI data was the big news, and it's come in hotter. So no let up. That adds to the inflation picture that we saw from the CPI data as well. PPI numbers all coming in hotter than expected, and last month, well, nearly as much as last month, that PPI there at 0.9, 1% last month, but all beating expectations. So again, on the inflation front, things are looking like they might be heating up a touch, which they're going to need to keep an eye on. Housing starts and permits came in a little softer. Starts down 14.8%. To 1.331 million, permits down 1.5% to 1.470 million. So missing expectations there, coming in lower than last month as well. I wasn't around, Kay. Was there any factors you saw behind this? January can be a bit of a funny month, weather and all that sort of stuff going on.
Absolutely. I think that's exactly it. We've seen, if you refer to the PPI, we've seen it in the CPI, and we've already then said perhaps we should already move to the next month to see whether the trend of stickiness continues, or was this a turn of the year move, or the hotter numbers and the building and housing starts will probably be the same. We will have to see what happens next month. And if you look at how the market reacts a bit in that way. Yes, we are continuously repricing market, trying to figure out where the central banks will be at what time, and it's going to be a continuing process. But if you look at the numbers as such, they fail to create fresh moves, right? We especially if you look at the majors, actually the dollar finding rally sellers, we must say. But I guess that's probably people who have been buying dollars and maybe take profit and then sit back and wait, because there is still so much uncertainty around the what's going to happen next, right?
Yeah, exactly. And a bit of a mixed picture. We got hotter inflation, but then retail sales weren't all that.
Yeah.
Great. Housing's not been all that. So yeah, it's, that soft landing that we've all been talking about may be getting just slightly bumpier.
Well, if you for the time being, not really. I haven't really looked at those building permits or housing starts, how the evolution of that was, but I think they came in relatively okay last year. But what we're saying was also, and what I've been saying in the past is, you are in this trend of we were in this trend of like higher yields, numbers keeping up much better, and everything. But now the trend has been changing, and then we were saying like, okay, the market is now going to figure out when what is to happen. So we are in this period now. We corrected the end of the year moves. And now we are in this period of, let's say, relative uncertainty, where if you see the numbers, if you see the data coming out, they are driving a bit less right now, or at least creating less of a trend, because we are trying to figure out what's going to happen next, right?
Yeah, yeah, exactly that. But I mean, coming in with sort of fresh eyes this morning, it does seem, looking at yields, US yields, it does seem that at least bond markets are taking the side of these high inflation numbers more so than the weaker economic data, which of course is the big thing for the Fed. They're expecting some weakness. They have been expecting some weakness, and it hasn't turned up.
And the thing,
so it's not going to be a surprise if it does eventually turn up. But their fight is still on inflation first and foremost.
That's true. And then if you look at how yields have behaved, you look at the 2 years, we are bang on the dot plot expectations. We are where the Fed put its dot plots in December. So market has been fighting it, but now coming right there. So I think as well there, the money market is showing us that we are probably at some sort of an equilibrium level right now, and saying like, okay, Fed, you tell us now what to do, or the data will tell us what to do. We are all data dependent, as we've been going on about. And it's funny to see that the market finally went back to where the plots showed us. And that's interesting in itself, because that means that the market has stopped somewhere fighting against the Fed, saying that no, we will have to get more than you guys were projecting. Now, a month and a half, 2 months later, 3 months nearly later, no, 2 months later, we are back at where they put the dot plot. So now we are ball back in the middle, and let the play begin again.
Yeah, exactly. Because I think after the stuff on Friday, I think we were pricing somewhere, I think 80, 85 pips of cuts this year. So it's getting very close to what the Fed are expecting that it's 75 pips. So yeah, the market finally, and we've been talking about it, that there was this divergence and it had to close at some point, whether it's the Fed to the market or the market to the Fed, and it's been the market to the Fed at the moment. We probably should be wondering when it's going to start going the other way and the market starts getting all hawkish again, if that inflation data continues as is, because markets don't like to sit in the middle for too long.
Yeah, exactly. Get a good labor report and a 0.1% beat of the next CPI expectation, and we're going to go the other way around.
Yeah, start pricing hikes again. But that's good for us because it gives us the volatility to trade anyway.
Absolutely.
When the market is in line with the Fed, that's when you ought to be careful that vol drops back even further when everyone's closely aligned. But anyway, cracking on. Michigan numbers as well out on Friday. Flash numbers there, and bit of an improvement. Not as much as expected, but still up on last month on the headline number. Current conditions just eased off a bit. Were expected to improve and came off a bit. The all-important inflation numbers saw the 1 year tick up to 3%. Had been heading lower. 5 year remained unchanged, though was expected to drop a pip there. So a little bit mixed numbers there, but nothing too damaged or anything by that. Fed heads, Fed barking, says the CPI data confirms why the Fed needs more confidence to cut. Fed's Bostic was out as well, saying was a little surprised by the data, but we have seen a lot of progress on inflation. He can live with the recent inflation data, but shows that the Fed should be patient on policy, and says there's still more work to do to lower inflation pressures. Says his outlook is to start lowering rates in the summertime and still expects 2 rate cuts in 2024. Now, this comment says there will be an art to the decision to start cutting rates. Now, I get a bit wary when they start getting very creative with their language to justify their hopes for policy and the economy. So saying there will be an art to cutting rates is a little bit airy-fairy, a little bit moving into sort of the hope trade. But he does say what a lot of Fed heads are going to be saying. Fed's daily as well, summing it up, saying there's more work to do on inflation. Says there's been remarkable progress on inflation, but there is no victory yet. We need more time and data to be sure of continued progress on inflation. And the risks ahead include slower inflation progress and a faltering labour market, and that the Fed needs to resist temptation to act quickly when patience is needed. I think, Kay, these inflation numbers are going to force the Fed to, or the Fed heads to keep up the wording that they're not there yet, more work to do, and that they may not be as quick to cut still as a lot of the market expects, even if the market's coming more in line with that. We've already seen, March has been completely scrubbed from the calendar. May got scrubbed as well. June's in the process of getting scrubbed. Could we be seeing cuts later than the summer now?
It's a fair question now, but I think we've already said just before we are in the middle and back to the dot plots and we wait to see what happens. Really, imagine that the February CPI number all of a sudden comes down. The same market is going to reprice more cuts again and pricing it earlier cuts again. This is the nature of where we are at right now. Interesting though is that Bostic in his comments, he is actually leaning for only 2 cuts this year. He's not really in the 3 cuts camp yet. So against him stands Goolsby, of course, who thinks that that CPI print was just a one-off take back, and then it's going to give it all back in the months to come. But I found it interesting that he's leaning towards only 2 cuts. I think it's on this. Well, that's still a bit to go, right? 6th of March, Powell is going to give his testimony. 6th and 7th. But in the meantime, we will have a bit more data as well to lean on. Has to be said that with this repricing now to being done and back at the dot plots, it's really an open book and an open play, and we see it actually in the FX markets as well. We come back, we trade the middle of the range, and now we wait and see. It does seem that FX is how shall I say, more a spectator of what's going on in the rest than really the driver, the actor. We are going to need some really a decent set of data to tell FX players to go and break some of these ranges again, which they're not really feeling very warm to do right now.
No, exactly. It's I've said it quite often, particularly this early part of the year, that when we get these big data weeks and event-driven weeks, where we close the weeks in a lot of pairs, will tell the story of how things are moving, and we're not seeing much closing anywhere really new in a lot of pairs, particularly the majors. So we're walking old grounds, but then that reinforces the ranges that we got to trade. So if we're not getting big moves, you know where your trouble points are and where you need to lean against. Anything you want to throw in? Because obviously I was off last week, so I may have missed bits and bobs that you were trading through. Kay, anything else?
I wouldn't say so. What I told already at the end of last week, record buying of Nikkei still by the investors, as we can see today, closing higher again. We are at those all-time highs again, back from the 1990. But I think anything world or shocking, not really. I think we have to look again at what's going on geopolitics, but in the Red Sea again. No, for the rest, really, for what's moving our stuff, there's not really a lot of fresh drivers to do anything. It's just, yeah, the market is still buying a load of Nikkei, as we can see over there. We are at record levels again. And what's interesting is that correlation of the yen versus Nikkei. Sometimes it breaks down a little bit, but we can see that that at times people are hedging their future gains on the Nikkei by selling a little bit of yen, and that's keeping the yen under the cush, especially in those crosses there.
Yeah.
Yeah, I mean that's about it, mate. What I have to say. Can I perhaps straight away take the Dimitri's any take on that gas? I personally don't. We can look at the picture, but you know, I found it quite interesting is that the people were saying that $2 should have been a bit of a bottom. And we are trading at near 1.5. Yeah. Is it not yet another bottom like the one in 2020 possible? But long here without a stop. Yeah. I don't know what your what you have invested in it, but yeah, it's like catching a knife now. It should have kept $2, and we're back at 1.5. I really don't know what to say on that one, apart from watch where it ends up compared to those 2020 lows.
Yeah, I was going to add to that. What can go wrong, Dimitri's? Well, you can lose your account. That's what can go wrong, because this can continue going lower. If you don't have a stop, then you're going to lose a lot of money if you're putting in big stakes on the table. So, yeah, you've got a bit of a defined area down here around this 1.5. So if we break below there, just like we broke below these 2 level, then yeah, then you can lose a lot of money. That's what could go wrong. So if you want to try catching a knife, be our guest, but you know, protect yourself. Okay, you're kidding. Cool. Don't catch us out on a Monday, Dimitri. It's too early in the week to be caught out by things like that. But yeah, if you want to go long, then just be careful. It's a good enough level by the looks of things to try it. But yeah, keep yourself protected, mate. What I was going to say about the yen, K, this could be setting up for one hell of a double top, couldn't it? If it holds up here. I mean, that's just...
in the short term, it can be. Oh, in the Nikkei, you mean?
Yeah, in the Nikkei.
Oh.
If that came, I mean, look, you can't take anything. You know, what happened in the 90s is not what's happening now. But on a technical basis, you know, that's a huge potential for a double top there, which means it will probably come back down. If it does confirm, it'll probably take another 5 years for it to come back down again. So if you're going to be trading ones like this, you need to have a bit of a long-term look on it rather than a 5-minute look on it. But yeah, for all intents and purposes, if they start tightening, and this should continue up, shouldn't it?
Well, not really. Normally, higher rates means lower equity markets. But if you just take 1-and-1 like we used to do it in the old days, but I mean, we are not in the old days. We've seen U.S. rates go up from 0 to 5%, and the S&P and other Nasdaqs and stuff putting in record highs. So who's going to say what? It all will depend on where if the people continue to invest in it or not. The thing is, where it could continue to shoot up is that the Nikkei could continue to rally, because the rest of the major central banks are cutting rates. So that could be one that is going to go on. And
I did see BlackRock as well touting Japanese stocks too. Oh, yeah. So
BlackRock, BNP Paribas. We know that Buffett has been in it for 1.5 years now. So yeah, and they've got like a very big suite of followers as well. So
yeah,
and
if they're pumping it. I was going to say, if they're pumping it publicly, it means they're already done. So we're probably near the top.
Oh yeah, it's like but well, yeah, it's like the good old days with Goldman Sachs and stuff. Buy dollar yen, and then you found out that they've been buying it for a big figure and just hoping for people to pay them out. So yeah, but I think stock equity markets are perhaps a little different in the sense that people want to have or need to have them. Their investment models are saying something. So they can go overhedged or or over-invested or under-invested compared to their models, but they will always invest, right? Now it's just a period where they massively invest.
Yeah. And Ali says, why is there saying in the old days that traders made a lot of money in this market and now the days of big money are gone? I wouldn't say that's the case, Ali. Markets are much bigger. There's a lot of people making a lot of money still in this. So, I wouldn't say that those days are gone at all. But conversely, there can be a lot of people that lose a lot of money these days. It's all become a question of scale. As things got bigger and more massive, then winnings are bigger and losses are bigger as well. So it's always. But if someone's losing, there's always someone winning on the other side. Usually the brokers. So don't you worry about that, Ali. If everyone was losing money, no one would do it. That's first and foremost. Right, I'm going to have just a brief look around, and I'll hand it over to K-Man because I said not too much going on this morning, so it's just going to be a few observations from me so far. Just looking back at stuff. What we've seen, particularly euro pairs, and it's a similar situation for euro sterling as well. We had a move down to the big 107. That's held. We've pushed off. We've come up towards the 108, but we failed to get into there significantly and hold a break above 108. So this downtrend still remains in play. I haven't yet started the fibs on the drop because we've got nowhere near the 38.2 yet. But this move down here is looking reasonably solid, and we've had a step up in that support against the former broken level. Again, I've shown this similar situation in the Aussie. We come down to a level, we hold it, we break it, we get back above, we hold it again. So this is conducive to finally perhaps seeing a bit more of a bottom in play here than we have done all year. But unless we start taking out the 108 and pushing up a bit higher and then maybe taking out this zone, the bearish trend isn't done yet. But a bit of a big figure battleground we've got at the moment, 107, 108. That's the ballpark. If you want to mess around in the middle, be my guest. But otherwise, I'm looking at the 107, 108 for this one. Euro sterling, again, similar picture. We had the move down to the lows, couldn't quite crack the 85. We had a bounce. It can't get above 85.70. Had another go late last week, Thursday. Couldn't get above there. You can see why it's a level up here because we've had lots of action around there. So again, we know the battleground. It's down at the big figure. It's up here at 85.70. So UK data needs to continue. We've got a bit more from the Eurozone this week, but not a huge amount of data coming through. It's obviously PMI week this week. Might as well do that quickly. Just have a quick look at the calendar to see what's coming. NAFL today, Canada and the US closed for holidays. Tomorrow, Canada CPI could be a bit of a mover for the loonie, of course. A bit of PPI data from New Zealand. RBA minutes. It's going to be, it's doubtful we hear anything new from that we haven't heard already 30 times from various RBA squeakers. Price index data, wage price index data from Australia. Not usually one that many people look at, but keep an eye on that because wages is a factor, as we know, for central banks. Get some UK data in the morning. Eurozone consumer confidence, forget that one. That'll be a minus number on that. Whether it's a better one or worse one remains to be seen, but it's always a negative number. FOMC minutes, Wednesday again. We've heard continuously from Fed heads, so I'm not sure we'll get anything new from that one. Final Eurozone inflation numbers on Thursday, but we do get all the PMIs kicking off for February, so that should hopefully give us some volatility to trade. If we see whether there's a further improvement, there has been a bit of an improvement in some of them, particularly the UK on services, but manufacturing still languishing the doldrums for a lot of countries as well. A bit more home sale or housing data to come as well. And then a bit of a quiet Friday. As you can see, GDP from Germany, IFO, and that's about it. So a bit of a quiet week this week, especially from the US numbers. So I don't know what we've been doing for inspiration. We'll have to make it up ourselves. Kay, did you want to take over the screens for a little bit?
Yeah, right. It's extremely quiet. I'm not going to show too much, but all right, perhaps a couple of things. Because something maybe interesting going on in the yen, as I noted this morning. And well, we know the yen pairs are still at very lofty levels overall. Picture doesn't seem to change too much right now. We're still finding buyers on dips, as we have seen here on Thursday, for instance, and we went back up to the level. But we are starting to hold this level, yeah? Just up in the 150.5s, 158, 80. We were hopping along this little trend line, broken, retested, and it came back down. But look at this. We are having like a very similar thing as pattern as we have seen from the end of December and into January. 1, 2, 3 steps higher, consolidate, coming back towards the end of the month. And then we started again. 1, 2, 3 steps higher, make a top, retest, and we are starting to go sideways. And we are around here in this process if you put it into February. Now, I'm not saying this is going to be a perfect overlay, but I'd say if it would happen, I wouldn't be surprised. Okay, that is something that I've noticed over the past couple of sessions, that this kind of formation, albeit with a bit of a lower amplitude, this move, logic, we did come off a lot, and we had a lot to rebalance, let's say. But it's looking like the same thing. So what does that mean to me is that for this pattern to break this month, we need to get back above 150.5, 150.80, and then we can go break this similar pattern. Now, what can happen is that we see exactly the same. Have this high again, and then we start to drift lower, perhaps into the end of the month. So keep an eye on that, and don't be surprised if that would happen. I'm just saying that this looks a bit similar to what happened last week. Now we've got a couple of those antipodians. They are trying and testing. Okay, we are against that level. We've broken it a little bit at the start of the week, also at the end of last week. Towards the close, we had a break of this 25.40 on the Aussie dollar, but we're there. Okay, so that shows us again that the FX market can do a move. Of course, it can do moves anytime. And I said that if the numbers would be weaker on Friday, remember, I said if the numbers would be weaker, this one could be one that is going for the break, and have a look at 66. Well, the numbers were not weaker yet. We closed relatively high. So that tells me that the Aussie, even though not breaking, it can go back down on strong US data, or if the Aussie market sees something that it doesn't like in those RBA minutes coming up next night, it's always possible that this turns around. But it does look like the facility with which it came back up tells me that this is not going to need too much or too bad, for instance, US data, or too much good Aussie data. Looks quite ready for pushing a little bit higher. Okay, just saying that the way it came back. Kiwi. So now the Kiwi market is starting to expect hikes. BNZ, another Kiwi bank, came out over the weekend saying that they also pushed back against earlier cuts by the RBNZ, or was also not in a hurry. And the Kiwi comes back also to retest the high of those of its latest range. But we need to respect those levels. And I said Kiwi needs to break above this 40.65 zone here again, or overnight or earlier today. We tried above 61.5. We just below. It's not giving back much, but we need to get above. Okay, hold the 55, hold break and hold the 65 to get into the 62s. Then I think if that goes, then we can get into the 62s. Okay. But it's all like, I don't think today, or it would be a surprise in an empty market also that we are going to go for those breaks, because with the US and Canada off, we are going to lose a lot of interest this afternoon, right? But just don't be surprised if it does one at one stage. Okay, this is one of the currencies that has been holding and coming back to retest their highs. All right, and then one that is starting to look, even though we are in this range, I don't know about the Noki. I haven't traded Noki for quite a while, but I'm starting to put it back on my radar. Yes, this is the intra-range little break, but it's showing perhaps some strength. I'm not going to say, because we're in the middle here. But if we start to break and hold below 1130 on the Euro Noki, I guess we can go back for another percent. Why not even 2% stronger on the Norwegian kroner? And the dollar Norway, even though it's going to the pointy end of the triangle, so the triangle doesn't really inspire me too much, but it does. If you just take the trend line, it does start to look perhaps a little bit better for the Norwegian kroner. Okay, goes back above 1060. I'm not going to say anything anymore, but and I don't have the position. Again, I don't have the position. It's just something that I've put on my radar. All right, this one here. For the rest, no. Looking around, there's absolutely nothing. Dollar Mex is resting on the 17. Can't bounce, can't break. Very neutral for now. Euromex does exactly the same thing. Came down and now it's bouncing around this zone of support here, 1030, 1036, 1830, 1836. This is what I've been talking about already regularly. So start of the week, all those guys are off. I don't think that there's going to be very, very big moves coming up. So really, I'm keeping the China on my radar, all right? But we have to note that we went for a test. We went for a test again, 722, the high 722, 723, and we're coming back down, okay? We really need for it to go higher. I tried it. I went long a bit, but I've let them go because we just don't break for now. If we have to go, it really needs to break above 723 and hold it, not immediately come back, all right? But we do still see it's not giving back too much either, right? We still see a bit of demand on dips as well, because the lows are higher and higher too. Okay, so with that, Ryan, back over to you, mate.
Thank you very much, mate. I did want to have a quick look at S&P, so I will share the screen again. Eventually, just give it some of this stuff here. This I'll keep in. What I wanted to see, because obviously we've been talking about the S&P and it had a decent refresh. Well, it had a decent refresh last week after the CPI data. Get rid of that thing now. But what's been significant is that we have bounced back. So we cleared out all the chasers in this move. We have bounced back. We couldn't get back to that high. We came short of that high, which is now potentially significant, because it is a stronger indication that we may have a bit more of a top than we've had in all this rally going on this year. So now we're just starting to get a bit more evidence of the top in play, which is important for people who are long, like me, because if we're running into trouble up here and we're going to make it hard work to break, then you've got to be looking at protecting what you've got, because shorts now have got something to get their teeth into. We've got this high, we've got this secondary high. So now we've had longer than a few days where the market couldn't get through. It's keeping the bids in play. We're not breaking back below 5,000, so that's going to be key again. You know, big data, big events, the level gets blown out, and a lot of levels get blown out as all the, as I say, all the late chasers get tipped out the market, and then the patient buyers come in down here and pick it up. So we're holding 5K again. This is probably going to be your decent pivot line now. If we move under there, that's going to solidify this top, and that's going to give shorts encouragement. So as I say, me being long, I'm looking at this now as it's a potential area I need to be concerned about, that the rally is faltering. But as you can see, we've got a long way to go before we start hitting fibs and the like, which will then determine whether this trend is going to change around that we've had this year. So there's a long way to go yet. The trend is still valid. That's a decent refresh, but it needs to take out this high. And if it can't, if we come up and test it, maybe we make another lower low around this 30 area. That would be another signal that we are potentially done with the upside for however long that may last. Could be a big top in play. We don't know until we start breaking down some of these levels. But as I say, evidence now is just building up a bit more as to why, you know, shorts might get a bit of traction coming in now and trying to pick tops, because the evidence is there to do so. Right, on that note, we should call it a day for today. A nice, easy one, just getting stuck into things. Yeah, Gavin, NVIDIA on Wednesday, that's going to be a big one for the for stocks, and for obviously the Mag 7 bunch of stocks that is keeping everything afloat. So we'll keep an eye on that on Wednesday. Cheers, Kay. Thanks for minding the shop last week while I was off. Thanks for all your stuff today. We shall see each and every one of you tomorrow. Have a good one all.